The information within a credit report is analyzed and then reduced into a number known as a credit score. A credit score is merely a tally that summarizes a person's credit risk. A bad credit risk is someone who has a history of not paying bills on time or not repaying their loan. Within the financial world, credit scores are used to predict which people are likely to manage their debt wisely in the future. The most widely used credit score was created by the Fair Isaac Corporation and is referred to as a FICO score. FICO scores can range from a low of 300 to a high of 850. The higher the credit score, the lower the credit risk. So having a higher score means that you have a lower credit risk and are therefore more likely to be approved for a loan. So the inputs that influence a FICO score are payment history, which is 35%, and so lenders are looking for on-time payments on loans. Then there's the amount of credit, which is 30%, so they want to see how much available credit do you have on your existing credit lines. Then there's the length of credit, which is 15% of the score, so the longer the length of credit, the better. And then the last two are new credit and types of credit, which are both worth 10% each. So less new credit is more valuable to your credit score, and more types of credit is more valuable. Applying for new credit or just receiving new credit can actually decrease your FICO score in the short run. The good news is that these inquiries have only a 14-day negative effect on your overall score. To have the highest credit score possible, you need a mix of credit types. Revolving credit includes credit cards like Visa, MasterCard, and Discover, and then installment credit includes student loans, mortgages, personal loans, and car loans. The big difference between the two types of credit is that the monthly payment on a revolving line of credit can vary, whereas installment loan payments tend to be fixed. So what is a good credit score? Well, 300 to 550 is considered low, and it usually leads to rejections for new credit. 550 to 620 is considered subprime, and so that indicates a high-risk borrower. So they would be charged high interest and high fees, and it limits the amount of credit that would be issued. A score between 620 and 680 is typically the minimum score to be accepted for most loans. A score between 680 and 740 represents individuals with good credit, so the terms and conditions of their loans will be favorable. And then 740 to 850 is the range that's considered excellent. Borrowers have stellar previous payment histories, and they receive the best borrowing terms. So how do you build a good or excellent credit score? Well, if you're establishing credit, start with just one application. So your strategy might be open a line of credit, for example, apply for and obtain a credit card. Use that credit card to buy necessary items like groceries and gas, and then repeat that process every month, keeping that account active. Try to never miss a payment. If you do miss one, get and stay current as quickly as possible. So the basic rules to optimize your credit score are: keep your revolving debt balances low, and if at all possible, pay those balances off in full each month. Apply the ratio rule. Lenders look at the total amount of credit lines available to you and compare that to how much you've used. This is called the credit usage ratio. So let's say, for example, you have 3 credit cards with a total line of credit of $10,000. If you have an unpaid balance or a revolving credit line of $5,000, your ratio is going to be 50%. 5,000 divided by 10,000. So someone whose unpaid balance is more than 30% of their total credit limit would likely have a lower credit score because that ratio is too high. Lenders don't like high ratios because they fear that the borrower may be overextended and unable to make minimum payments in the future. On the other hand, having tens of thousands of dollars of available credit may also be considered risky because at any moment that borrower could incur large debt. So tens of thousands of dollars of available credit can also be viewed negatively by lenders when applying for other loans. So basically, don't carry a balance and avoid having excessive available credit. Another basic rule for optimizing your credit score is avoid applying for lots of new credit cards at one time. Individuals with a longer positive credit history tend to have a higher credit score. Opening new credit lines can decrease your score, as can having a flurry of credit or loan applications. Your score will drop because other lenders will see that you may be on the verge of going into more debt in the future. And then lastly, vary your credit mix. Someone with 10 credit cards and no other credit will have a lower score than someone with a blend of credit cards, car loans, student loans, and other accounts. This will likely happen naturally over time, as you may have a need for student, auto, and housing loans.